All right, today we're going to dig into a really fascinating tale, a tale of two cryptos. But here's the twist. We're not going to look at the price. Nope, we're following the big money, the institutional cash. And trust me, the story it's telling, it's one you're going to want to stick around for. So here's the puzzle that got this whole thing started. You've got this fire hose of capital, I mean serious money, just pouring into one crypto while its price is, well, kind of falling. And at the exact same time, that same type of money seems to be running for the hills, away from the big one, Bitcoin. How does that make any sense? It totally defies logic, right? Well, let's figure out what's really going on. Yeah, the market is telling two completely different stories at the same time. And if you really want to understand what's happening, you've got to tune out the noise, the screaming price charts, and instead follow the quiet, deliberate flow of actual money. Just look at this. The contrast is wild. Over here on the left, you've got Bitcoin. Back in December, its ETFs, and those are the main ways big institutions invest, they saw major money leaving. But then you look to the right at XRP, and it's a totally different story. A record-breaking surge of institutional cash flooding into its ETFs. It's a complete 180-degree split. And this image, wow, it just captures that divide perfectly, doesn't it? You can see these powerful green arrows showing all that capital just surging into XRP. But at the same time, Bitcoin's dealing with these serious headwinds. You can almost feel the pressure, see the cracks forming in the ice. Now, here's the most important thing to get. This isn't random. This is pure strategy. So if we want to solve this puzzle, we have to get inside their heads. We have to understand the institutional mindset because, look, big money, I'm talking pension funds, massive asset managers, they are not playing the same game as the average trader. They have a completely different rulebook. For them, it is all about strategy. Emotion is out the window. These guys aren't panic selling when the market's red and they're not chasing some crazy green candle. No way. Their moves are calculated. They're planned out, sometimes for weeks or even months. Think of them as the grandmasters playing chess, while everyone else is playing checkers. So what's on their checklist? What actually drives these huge decisions? Well, it pretty much boils down to these key factors right here. They're asking, is there regulatory clarity? Check. How does this thing help diversify our portfolio? Check. Is the infrastructure solid enough to handle billions of dollars? And does buying this fit our specific timing and our mandates? These are the questions that actually move markets. And this quote, it just says it all, doesn't it? ETF buying is mechanical and planned, not emotional. The buying that happens through these massive funds, it's like a machine. It's all part of a plan. And that right there, that's why an institution will happily buy up an asset while the price is dropping. To them, that's not a red flag. It's a sale. It's a golden opportunity to load up and hit their targets at a discount. Okay, so let's take that cold, calculated mindset and point it directly at XRP. Why are they buying so much? What's the deal? Well, it's actually pretty simple. For them, it's like a whole new asset has just been unlocked, and it's finally ready for them to invest in. The number one reason, the biggest catalyst by far, has been regulatory clarity. You got to remember, for years, XRP was stuck in this legal gray area that made it totally untouchable for these big compliance-heavy funds. But once it got that stamp of regulatory acceptance, poof, that massive barrier just disappeared. It was the ultimate green light. It basically put XRP on the menu for these giants for the very first time. And the impact? Oh, it was immediate, and it was powerful. Just get a load of this number. More than 53 consecutive days of money flowing into XRP ETFs right after they launched. This wasn't some one-day blip. This was a steady, relentless wave of big money building a position. And the sheer intensity of this buying, it's just staggering. I mean, look at this chart. On certain days, you're seeing almost $50 million in new money pouring in a single day. That kind of pressure pushed the daily trading volume to all-time highs. This, right here, is what it looks like when the giants of finance decide it's time to buy. But it wasn't just about the regulations. XRP also offers something pretty unique for a portfolio. See, it's not just trying to be another digital gold like Bitcoin. Its whole reason for being is tied to real-world stuff, like global payments and settlements. So for a big institution that's trying to build a really diverse crypto portfolio, that makes XRP super attractive. It's an asset that doesn't just move in lockstep with everything else. All right, now let's flip the coin and look at the other side of this story, Bitcoin. If XRP's story is all about getting the green light, Bitcoin's is more like a flashing yellow. Yeah, the price might have looked pretty strong on the surface, but the big money, the institutions, they were seeing some serious warning signs hiding just underneath. And this image here illustrates those risks perfectly. The best way to think about it is like walking on cracked ice. From a distance, the surface looks solid, right? But underneath, there's a serious fragility. And specifically, these institutions were getting worried about two things, what they call fragile liquidity and the growing shadow of the big holders, the so-called whales. So what the heck is fragile on-chain liquidity? Well, it's basically a market state where there isn't a whole lot of actual buying and selling happening on the exchanges. It's kind of quiet. And when things are that quiet, it doesn't take a very big sell order to cause a massive, dramatic price drop. Why? Because there just aren't enough buyers sitting on the sidelines ready to soak it all up. Here's the perfect analogy for it. Imagine a really shallow pond. If you make even a small splash, you get these huge, dramatic waves, right? But if you do that same splash in a deep pond, that's a highly liquid market, it would barely even make a ripple. That's the kind of elevated risk the big players were seeing with Bitcoin. So you put all that together, and it creates a whole lot of short-term uncertainty. You had more whales moving their coins onto exchanges, which is often a sign they're getting ready to sell and take profits. And when you mix that with an environment that has fragile liquidity, well, it means the risk of a really sharp, volatile drop was, for them, uncomfortably high. Okay, so where does all of this leave us? What should you be watching for next? Because if there's one thing we've learned today, it's that the price chart alone, man, it just never tells you the whole story. Here's a simple framework for you, kind of like a cheat sheet. For Bitcoin, the thing to watch is whether its ETF flows stabilize. If you see that money start to come back in, it probably means the December outflows were just a seasonal thing, not some big structural shift. And for XRP, you're just watching to see if that strong demand for its ETFs keeps up. If it does, that confirms this whole buying spree is part of a real, long-term institutional plan. And really, that brings us to the biggest takeaway from this whole deep dive. If you truly want to understand what's going on in the market, you absolutely have to look past the flashy headlines and the crazy price swings. You have to learn to follow the silent but incredibly powerful flow of capital. So I'll leave you with this question. In a market that's this complex, one that's driven by such powerful players, what's the smarter move? Do you let yourself get distracted by the price, or do you focus and follow the money? Something to think about. Thanks for tuning in.